In March 2025, Bitcoin touched $74,000 and then stopped cold, as if the entire market had hit an invisible wall no one could see. Something powerful was happening far beyond the trading screens and crypto exchanges of the digital world. The answer was not found in blockchain data or wallet activity, it was found in oil fields, missile strikes, and the decisions of powerful governments. Welcome to the secret treasury, where money, influence, and history intersect. Subscribe to trace the flow of power behind the headlines. For years, Bitcoin had been sold to the world as a financial island, a place where governments and wars could not reach. That idea was about to be tested in real time, on a global stage, with trillions of dollars at stake across every market on Earth. To understand what happened in March 2025, you must travel back to the foundations of how global money actually moves. Every major financial market on Earth is connected to one thing above all else, and that one thing is the price of oil per barrel. When oil becomes unstable, every other market, from bonds to equities to digital currencies, begins to feel the pressure almost immediately. This is not a theory. It is a pattern that has repeated itself across every major financial crisis since the 1970s oil embargo. The Middle East sits at the center of global oil supply, and Iran is one of the most consequential oil producers in that entire region. Iran produces millions of barrels of crude oil per day, and its export decisions shape energy prices for countries on every continent. In early 2025, the relationship between Iran and the United States reached one of its most dangerous points in over 2 decades. Sanctions, nuclear negotiations, and military positioning all collided at the same time in a period of extraordinary geopolitical tension. The United States Treasury had spent years building one of the most complex financial pressure campaigns ever designed against a single nation. It targeted Iranian oil revenues, froze international banking relationships, and cut Iran off from the global dollar clearing system. Iran had survived previous rounds of sanctions, but this new campaign was more precise, more coordinated, and more damaging than anything before. Iranian oil tankers were being tracked by satellite, flagged in real time, and blocked from entering port in countries across Asia and Europe. Refineries in China, India, and Southeast Asia that had quietly purchased Iranian crude were now facing secondary sanctions from Washington. The pressure was enormous, and Iran was watching its primary source of government revenue shrink with every passing month of 2024 into 2025. Inside Tehran, government officials were running the numbers, and the numbers were not moving in a favorable direction for the regime. Foreign reserves were falling, inflation inside Iran was accelerating, and the population was experiencing serious economic hardship in daily life. Governments under this kind of sustained pressure do not simply accept the situation. They look for leverage, and Iran found its leverage. The Strait of Hormuz is a narrow waterway located between Iran and the Arabian Peninsula, measuring only 33 kilometers at its most narrow point. Approximately 20% of all the oil traded on the entire planet passes through this single stretch of water every single day. If that strait were to be disrupted for even a few days, the shock to global energy markets would be immediate and severe in scale. Iran had repeatedly used the threat of Hormuz disruption as a negotiating tool in past standoffs with the United States and its allies. But in early 2025, something felt different to analysts and intelligence agencies watching the situation from Washington and European capitals. And Iranian naval forces had been conducting larger exercises than usual in the Persian Gulf, and satellite imagery confirmed increased coastal missile activity. Regional tensions were not staying regional. They were spilling into the calculations of every major institutional investor around the world. Goldman Sachs, JP Morgan, and other major financial institutions began quietly updating their risk models to account for a Middle East disruption scenario. Insurance rates for oil tankers passing through the Persian Gulf began climbing, a small but telling signal that professional risk managers were worried. When professional risk managers become worried, capital begins to move, and when capital moves, every connected asset class feels the shift. Bitcoin had been riding one of its most powerful bull runs in years, fueled by the approval of spot exchange, traded funds in the United States. Institutional money had flooded into Bitcoin through these new products, pushing prices from under $40,000 all the way towards $74,000. The narrative was intoxicating. Bitcoin was finally growing up, finally becoming a legitimate piece of the global financial system, in a real way. Pension funds, endowments, and major wealth managers had begun allocating small but meaningful percentages of their portfolios into Bitcoin exposure. This was supposed to be the moment Bitcoin proved itself as a store of value, separate from the noise of traditional geopolitical risk. But that thesis had a hidden flaw, a flaw that became visible only when the macro environment shifted with enough speed and severity. The institutional money that had entered Bitcoin through exchange-traded funds was not pure crypto conviction money, it was allocated risk capital. Allocated risk capital follows rules, and one of the most important rules is that when overall portfolio risk rises, risky assets must be reduced. Bitcoin, in the eyes of institutional portfolio managers, remained one of the highest volatility assets across any major asset class anywhere on Earth. When geopolitical stress began rising in the Middle East during February and March of 2025, portfolio risk systems started flashing warning signals. The signals were not about Bitcoin specifically, they were about the broader risk environment, but Bitcoin felt the consequences just as sharply. Risk-off is a term used by financial professionals to describe periods when investors move out of volatile assets and into safer ones rapidly. Gold, United States Treasury bonds, the Japanese yen, and the Swiss franc are classic safe haven destinations during risk-off market conditions. Bitcoin had tried for years to position itself alongside gold as a safe haven, but the market had not yet fully accepted that classification. When the sell signal came, portfolio managers did not distinguish between crypto conviction and crypto allocation. They reduced exposure across the board. The Bitcoin chart, which had been climbing beautifully towards $74,000, began to flatten, then stall, then roll over in early March 2025. Retail investors watching the chart did not immediately understand what was happening, because the reason was not visible on the chart itself. The reason was in oil futures markets, in Persian Gulf satellite data, in treasury briefings, and in the risk management systems of large institutions. This is the invisible architecture of modern financial markets, the layer beneath the price that most ordinary investors never see or understand. Understanding this layer is not about being cynical about markets. It is about seeing the world as it actually operates rather than how it is sold. The oil market had been sending signals for weeks before Bitcoin peaked, signals that experienced commodity traders were reading with growing concern. West Texas Intermediate crude had been climbing steadily, and Brent crude, the global benchmark, had crossed above $85 per barrel. Every dollar increase in Brent crude above $80 acts as a slow tax on the global economy, reducing growth expectations slightly but measurably. Central banks, particularly the United States Federal Reserve, watch oil prices carefully because energy inflation feeds directly into consumer price inflation. When oil rises and inflation risks increase, the Federal Reserve becomes less likely to cut interest rates, and that changes everything for risk assets. Bitcoin and other high-growth, high-risk assets perform best in environments where interest rates are falling or expected to fall in the near future. When that expectation shifts, when rate cuts get pushed further into the future, the math behind holding volatile assets becomes less attractive immediately. In February 2025, Federal Reserve officials began making public statements that were more cautious about the pace of potential interest rate reductions. The language was careful and professional, but the message was clear to anyone who had spent time studying how central bank communication actually works. The Fed was watching inflation data, watching oil, watching Middle East tensions, and deciding that patience was more prudent than action at this time. That single shift in expectation, from rate cuts coming soon to rate cuts maybe later, was enough to change the mood across risk asset markets broadly. Bitcoin felt this shift acutely because Bitcoin had no earnings, no dividends, and no cash flow to fall back on when investor sentiment changed. Its price is built almost entirely on expectation, on the belief that future demand will exceed current supply, and expectations are fragile things. When the macro story supporting Bitcoin began to weaken, the price began to weaken, and the weakness fed on itself in a familiar market pattern. Long traders who had bought Bitcoin above $60,000 began watching their profits shrink, and some decided to protect their gains by selling. Derivatives markets, where traders use leverage to amplify their bets, began to show signs of stress as large leverage positions started to unwind. Each forced liquidation pushed the price slightly lower, and each lower price triggered more liquidations in a cascading pattern well known to market observers. This is called a liquidation cascade, and it is one of the most powerful short-term forces in cryptocurrency markets when conditions align for it. The cascade that hit Bitcoin in March 2025 was not the largest in history, but it came at a psychologically critical moment near all-time high prices. Billions of dollars in leveraged positions were liquidated over a period of days, pushing Bitcoin down sharply from the $74,000 peak level. Charts that had looked like they were preparing for a breakout to $80,000 suddenly looked like they were rolling over into a deeper correction. The mood on social media, in trading forums, and across financial news networks shifted from excitement to confusion to concern remarkably quickly. People who had been celebrating a new era for digital assets were now asking the same question that always emerges when prices fall unexpectedly hard. What changed, and why did it change so fast, were questions echoing across every platform where cryptocurrency is discussed and analyzed in real time. The answer required stepping back from the price chart and looking at the world map, at oil fields, missile batteries, and government balance sheets. It required understanding that Bitcoin, despite all its technological uniqueness, had become part of the global financial system it once sought to replace. And global financial systems do not exist in isolation. They breathe the same air as geopolitics, energy markets, and the decisions of central banks. The story of Bitcoin at $74,000 is really a story about how everything in the modern world is more connected than most people realize today. It is a story about Iran and oil and sanctions and Federal Reserve language and risk management algorithms running inside the largest banks on Earth. It is a story that has played out in different forms many times across financial history, always with different actors, but always with the same logic. Power flows through money, and money flows towards safety when the world feels uncertain. And in early 2025, the world felt very uncertain indeed. Bitcoin had fallen sharply from its peak, but the full story of why was still unfolding across trading floors and government offices around the world. The price drop was visible to everyone, but the chain of causes running beneath the surface was invisible to most people watching the charts fall. To understand the second half of this story, you must follow the money backward, from the crypto exchanges all the way to the oil fields of Iran. Iranian oil exports had been falling for months under the weight of coordinated sanctions enforced by the United States Treasury and allied governments. The revenue shortfall inside Tehran was creating internal pressure that outside observers could measure only through indirect signals and leaked reports. Iranian officials had publicly warned multiple times that continued economic pressure would force a response in the energy domain, not just diplomacy. Those warnings had been dismissed by some analysts as routine posturing, the kind of strong language governments use during negotiation standoffs. But in late February 2025, the warnings began to look less like posturing and more like preparation as military activity in the region increased visibly. Iranian aligned groups in Yemen, Iraq, and Syria began conducting coordinated operations that disrupted shipping lanes and energy infrastructure simultaneously. The timing was not accidental, and intelligence analysts in Washington and London noted the pattern with growing concern in their internal briefings. Each disruption sent a small shockwave through energy futures markets, nudging oil prices slightly higher with each successive incident reported publicly. Traders in oil futures markets do not wait for confirmation before they act. They price in risk the moment credible information enters the market. By early March 2025, Brent crude had climbed above $88 per barrel, a level not seen consistently since the energy crisis period of recent years. At $88 per barrel, the economic math for global growth began to deteriorate in ways that central bank models could not easily absorb or ignore. Higher energy costs reduce corporate profit margins, increase transportation costs, slow consumer spending, and push inflation higher across entire economies. The Federal Reserve had been navigating a delicate path between cooling inflation and avoiding a sharp economic slowdown for well over a year at this point. Rising oil prices threatened to undo months of careful progress on inflation, and that threat forced a recalibration of the entire rate cut timeline. Federal Reserve meeting minutes released in early March 2025 confirmed what bond market traders had already suspected from watching yield curve movements. The committee was not comfortable cutting rates, while energy inflation remained elevated and geopolitical risk in the Middle East continued to escalate. That confirmation hit risk asset markets like a cold wave, because the single biggest tailwind behind Bitcoin in early 2025 had been rate cut expectations. Institutional investors who had entered Bitcoin through exchange traded funds had built their position thesis partly around falling interest rates ahead. When that thesis weakened, position sizes that had felt comfortable at $60,000 per Bitcoin suddenly felt uncomfortably large at $70,000. Risk management teams at large asset managers began running scenario analyses, modeling what Bitcoin exposure would look like if rates stayed higher longer. The scenarios were not catastrophic, but they were sobering enough to justify reducing exposure until the macro picture became clearer and more stable. Selling by institutions is fundamentally different from selling by retail traders, because institutional selling is large, methodical, and sustained over time. It does not happen in a single dramatic moment. It happens in steady daily reductions that gradually shift the supply and demand balance in the market. This kind of selling is nearly invisible in real time, but its effects accumulate over days and weeks until the chart pattern becomes impossible to ignore. Bitcoin had been absorbing this institutional de-risking quietly for about 2 weeks before the price action became alarming enough to generate headlines. By the time mainstream financial media began covering the Bitcoin correction heavily, the largest portion of institutional selling had already occurred. This is one of the most consistent patterns in all of financial market history. The news always arrives after the smart money has already acted. The retail investor watching the evening financial news and seeing Bitcoin coverage for the first time was seeing yesterday's story told in today's voice. The real story had been written in oil futures, in Federal Reserve meeting rooms, in Treasury Department sanctions enforcement, and in Tehran government offices. This layered reality is what makes financial history so endlessly fascinating and so frustrating for people who try to understand markets from the surface only. The surface shows you prices going up and prices going down, but the depth shows you why. And the why is almost always more interesting than the what. Iran had not directly sold a single Bitcoin. The Federal Reserve had not issued a single statement about cryptocurrency, and yet both had moved the market. This is the concept of macro contagion, the process by which events in one corner of the global system ripple outward into every connected market. Bitcoin had become connected enough to global capital flows that macro contagion could now reach it just as surely as it reaches stocks or bonds. That connectivity was actually a sign of maturation in one sense, but it also permanently changed the nature of what Bitcoin is as a financial instrument. A truly isolated asset would not have responded to Iranian sanctions or Federal Reserve language, but Bitcoin was no longer truly isolated from these forces. The exchange-traded fund approvals of early 2024 had been celebrated as a victory for cryptocurrency legitimacy, and in many ways they genuinely were. But legitimacy inside the traditional financial system comes with a cost, and that cost is exposure to the same forces that move traditional financial assets. Bitcoin had entered the portfolio, and the portfolio had rules, and the rules said that when macro risk rises, volatile assets get reduced in size. Understanding this dynamic is not a reason to feel negatively about Bitcoin as a technology, or as a concept. It is simply a reason to understand it clearly. Clarity about how markets actually work is one of the most valuable forms of financial education a person can receive in the modern economic environment. The correction that followed the $74,000 peak was painful for many people who had entered the market during the excitement of the preceding weeks. Prices fell from $74,000 to levels below $60,000 within a relatively short period, representing a significant drawdown from the peak. Every major Bitcoin correction in history has felt different in character, but similar in pattern: a peak, a sharp fall, a period of confusion, then resolution. The confusion phase is always the most psychologically difficult, because the narrative that supported the peak has not yet been replaced by a new one. In March 2025, the confusion phase was extended because the macro environment remained genuinely uncertain, with oil prices and geopolitical risk still elevated. There was no single news event that resolved the tension. No treaty signed, no Federal Reserve announcement that suddenly restored the rate cut timeline. Instead, the situation evolved slowly, as geopolitical situations almost always do, through incremental diplomatic contacts and gradual market recalibration. Oil prices began easing slightly by mid-March as some of the most acute military tension in the Persian Gulf showed signs of de-escalation. The de-escalation was fragile and incomplete, but it was enough to shift the probability calculations that institutional risk managers were running. As oil pulled back from its highs, inflation expectations moderated slightly, and bond markets began pricing in a slightly more favorable rate outlook. These are small movements individually, but in interconnected financial markets, small movements in foundational assets create larger movements in risk assets. Bitcoin stabilized, then began recovering, not because anything specific to Bitcoin had changed, but because the macro pressure around it had eased slightly. This recovery pattern is itself a form of confirmation that Bitcoin had genuinely become part of the broader financial system in a structural way. Assets that are truly disconnected do not recover when macro conditions improve. Only connected assets respond to changes in the macro environment this way. The paradox at the heart of the Bitcoin story in March 2025 is that the same connectivity that made it vulnerable also made it capable of recovering. Iran, oil, and macro forces had pushed Bitcoin down, but the same system that pushed it down also contained the mechanisms for bringing it back up. This is the fundamental nature of modern financial markets. They are systems of interconnected pressures that push and pull against each other constantly. No single asset, no matter how revolutionary its underlying technology, exists outside this system once it has been adopted by large pools of capital. The lesson of March 2025 is not that Bitcoin failed, it is that Bitcoin had grown large enough and connected enough to reflect global macro reality. That is actually a remarkable statement about how far digital assets had traveled in the roughly 15 years since the first Bitcoin block was mined. From a white paper published during the global financial crisis of 2008 to an asset reflecting geopolitical risk in the Persian Gulf by 2025 is extraordinary. The people who built Bitcoin originally wanted to create a financial system the governments could not control, and geopolitics could not reach or damage. What they created instead was something that became so valuable and so widely held that the world itself could not stop affecting it in return. That irony is one of the most profound in the entire history of financial innovation, and it deserves to be understood rather than simply mourned. Every great financial innovation eventually becomes part of the system it sought to replace or reform. That is the pattern across centuries of history. The question for the future is not whether Bitcoin will be affected by macro forces, because the evidence of March 2025 confirms that it will be. The question is whether the people holding and building within the Bitcoin ecosystem understand this reality clearly enough to navigate it with wisdom. Wisdom in financial history has always meant the same thing: understanding the system you are inside rather than imagining you are outside of it. The oil fields of Iran, the meeting rooms of the Federal Reserve, and the trading floors of institutional investors are all part of Bitcoin's story now. They were always part of it in indirect ways, but March 2025 made the connection undeniable, visible, and permanently written into the historical record. When the next moment of maximum excitement arrives in digital asset markets, and history strongly suggests that it will, Remember what you learned here. Remember that price is the surface, and beneath the surface lies a vast and interconnected architecture of energy, politics, money, and human decisions. If this story moved you, hit subscribe button. The past holds powerful lessons, and I will help you uncover them.